Welcome to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. The Commercial Real Estate Show is your source for insightful analysis and enlightening discussions. And today we certainly have some enlightening discussions. Our show today is called The Fed's View of Commercial Real Estate. Please welcome my guest. It's Brian Bailey. He's Senior Policy Financial Analyst with the Fed, and he's at the Atlanta's Fed office, and he's joined us here in Studio One. Brian, thanks for being with us.
Michael, it's great to be back. Thank you for having me.
Well, great. We know, to start off, I'm just so glad that you're here speaking for the entire Fed and for Obama. Let us know what he thinks, right?
Well, it's very kind of you, but in all fairness, really these are going to be my views and not necessarily those of the Federal Reserve Bank of Atlanta or the Board of Governors in Washington, D.C.
Or Obama.
Yes, sir.
So the disclaimer's out of the way.
Yes.
That's good. Well, first of all, for our listeners, tell us, and our viewers, why does the Fed watch commercial real estate? How do you guys watch commercial real estate, and who leads that charge?
Sure. Real estate is a very important sector for the economy. Between construction and residential and commercial, as well as some of the infrastructure, and it gets a little nebulous as far as the accounting per se, but roughly my view is that it accounts for between 6 and 7% of the gross domestic product. So it's very important to the nation's economy. It's very important to the Fed, whether it's through monetary policy, which is one of our charges, or whether we have to look at it regarding our bank regulation function, the supervision and regulation of the banks. We're one of the primary bank regulators, and so certainly have to be aware of what's going on in residential and commercial real estate.
And how do you go about watching? How does the Fed look at real estate?
We spend a significant amount of resources and time, whether it's monitoring the fundamentals, monitoring the lending climate, how easy, how hard is it to get loans, but also looking at the affordability of residential real estate to make to understand if it's creating a hardship on the individual level. But we spend a significant amount of time trying to make sure that that there's transparency, that the economic conditions are conducive to the economic climate of the country.
Okay, and who leads the charge?
Well, so I'm a subject matter expert in commercial real estate, and so I'm spending all my time looking at commercial real estate. But we have a number of experts across the nation that look at various pieces of industry. Right. So there are a lot of us, and a lot of we'll have a lot of very sharp colleagues out there.
Right, and I think one thing that the public might not realize is the profitability of the Fed. So is the cost of the Fed's not really coming out of the taxpayer's pocket directly?
That's correct.
Yeah.
We're independent. We're accountable to Congress, but Congress has given us the ability to charge for the services that we provide to the financial institutions. And you probably just saw the article within the last 2 weeks or so, but the Fed made about $97 billion, billion with a B.
Thank you.
And that gets turned over to the U.S. Treasury.
Okay. Well, thank you for that.
Yeah, it was a good year. Merry Christmas. Yes.
So you're leading the charge, and you're tracking residential and commercial real estate. So when Obama gets out of office and he calls you and say, "Should I buy or rent?" What's the word for him? Huh?
Well, you're too kind. You're too kind. I follow commercial real estate. And we're watching the conditions right now. I mean, certainly we've seen a significant improvement in those conditions.
Yeah.
So I'm sure you probably see in your daily life.
Yeah, I think it's still a good time to buy, and whether it's residential or commercial. So what is the status right now of commercial real estate related to banks, and how's the banking industry doing right now?
Well, the banking industry, is seeing a pickup in demand for lending. So certainly good news there. From my perspective, from the banks that I've been in, I see disciplined lending going on. So certainly, I think that is good news. Specifically, though, as far as the balances on lending, balances in multifamily, balances in owner-occupied space, single tenant buildings, that kind of thing. In other CRE, which is parlance for kind of leased or investment or real estate, those balances are at all-time highs over the last 7 or 8 years. So certainly, banks are lending more on stabilized properties. The question has been the C&D, the construction and development projects. And we are seeing the banks getting back into lending on those projects. Again, it's slow, they're cautious about it, which certainly is a good thing after what we went through in the financial downturn. But it's great to see them getting back and seeing a little bit more velocity in that arena.
Yeah. Well, it's a big profit area for them, right, to do these types of commercial loans?
I think it is. It is profitable, and I think that it is necessary for the economy, because we just talked about how important construction is for GDP.
Yeah, right. That's true. And let's talk about the banks a little more. So, how much loans should they do? I mean, is there a limit that the Fed would recommend to a certain bank? Hey, don't go over this amount, or
And obviously there is some guidance on concentrations that we have put out, whether it's commercial real estate, whether it's the construction piece. So there is some guidance on that, but certainly some of it is also driven by the bank's risk tolerance, and what does their board of directors feel like that they can be profitable at. Certainly we've seen some banks that whether they grew too quickly or they grew and entered spaces that were outside of their core areas of competency, and a number of those institutions ran into it. So certainly I think having the intellectual capital knowledge base in a certain lending area is very important.
Yeah. Well, let's talk about underwriting, because I think some borrowers out there would think the underwriting is too stiff still. And I guess every bank and lender is going to be different. But what do you see overall for underwriting standards?
So I'd refer you back to the Federal Loan Officer Survey that the Federal Reserve does every quarter. And what we've seen is that there's been a growing appetite for almost all the loans except for multifamily. And that has kind of stayed, pretty much. There hasn't been, a tightening in underwriting standards. There hasn't been a loosening in underwriting standards, but really the banks have just kind of said, we're comfortable at the level that we're doing multifamily loans. The other areas. There does seem to be a growing appetite, according to that survey, for new loans in those areas, and banks are, carefully, cautiously, loosening their underwriting standards to get some of those new loans.
Okay, and let's talk about interest rates. The Fed has been increasing the rates here slightly. They made their first move, I guess, in December. But that's not a one-for-one rate increase for commercial real estate borrowers, is it? What do you see for interest rates for commercial real estate borrowers right now?
Well, certainly it was a historic occasion after a number of years, finally to have the economy improve enough where we can begin to tighten rates carefully. Certainly is a good thing. As far as what I've seen, it's really not translated into a lot of movement in the financial institutions as far as I've seen. I didn't expect, nor has it occurred, As far as the one-to-one tightening that you mentioned, haven't really seen that happen. I think it's been very orderly. It seems to me that that notion was well received from the market, and they seem to not be surprised by our move. So I think we did a very good job in articulating that, and I think it's certainly we'll continue to see how the national dynamics of the economy continue to have an impact on interest rates going forward.
Well, that's a good point. I think it was expected, and I think the Fed did a great job of making sure we did expect it and rolled it into our analysis. Well, stay tuned. We're going to talk more about the Fed's view on commercial real estate. I'm Michael Bull. This is the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we're talking about the Fed's view on commercial real estate. We have Brian Bailey here with us in Studio One from the Fed, and he watches commercial real estate for the Fed. And Brian, one of the things that we're starting to hear from some of our guests and some of our clients and some of the talking heads is the word bubble, that because of maybe the low cost of money, the amount of foreign capital and domestic capital looking to go into commercial real estate, that maybe in some of the gateway markets, some of these 3 and 4 cap rates, that maybe some people are the market's overheated, that they're overpaying. What do you think?
Well, it certainly is a very popular word to use these days, whether it's bubble or froth or that kind of thing. Mm-hmm. And certainly we're spending a lot of time monitoring prices and a number of other fundamentals, trying to kind of understand the dynamics of the market, and are things getting a little bit ahead of itself. But one of the things we looked at was prices in the major markets. Historically they're up about 7%, which sounds fairly reasonable. If you look at the change in the last year, they're up 18%. So certainly a pretty sizable jump there. When you go back and look at the last 5 years, prices are up about 19% a year. So prices have almost doubled in the gateway market. So certainly, you're seeing some of the data that certainly would make you wonder or want to take a little bit greater look at it. In the non-major markets such as Atlanta, Dallas, Miami, prices historically are up about 4%, and our data is about 15 years. It's provided by Real Capital Analytics. The prices in last year up 13%. Mm-hmm. So up 3 times. Last year they're up 3 times over the rate of the historical average. So certainly question there. You look at various segments, and certainly apartments and CBD office stand out pretty significantly. Their apartments are 33%. Apartment prices are 33% above the peaks. CBD office is 44% above the peaks that we saw in 2007. So certainly we have to continue to watch. At the same point, prices for retail, which is 9% below the peak, and then suburban office, which is about 7 or 8% below the peaks. So certainly you see kind of a dichotomy when you've got some very hot sectors and some not so hot. I mean, certainly it's picking up steam in those areas. And probably, as everybody's aware of, performance is very specific to the location, to the property type, to the tenant. I mean, there are a number of important factors that impact value. But certainly we see, kind of a resurgence. So if you look at prices in the last year for apartments, retail, industrial, the rate of growth is 2 and 3 times what we see over the long-term historical averages. So certainly it does give some credence to the fact that people are saying, things look pretty robust. Why is that? My view is that we've seen a lot of capital come in. At the same time, the national economy has really begun to accelerate and create significant amount of jobs at a consistent pace over the last 2.5 years. So you begin to have enough time where fundamentals have improved. We've taken slack out of the vacancy, and now all of a sudden we're beginning to see some pressure on rents. So my hope is that we see some continued improvement in fundamentals, and the cash flow side of the valuation equation begins to kind of pick up steam a little bit. Certainly the availability of capital is huge right now. Foreign capital last year, the preliminary numbers put estimates around $90 billion in foreign capital came into the U.S., which is huge. I think it's up 75% from the prior peak in 2000, in the prior year. So I mean, we're seeing huge amounts of capital continue to come to the U.S. Part of it's safety, part of it's the opportunity for investment. So really a number of factors right now are contributing to the resurgence in price. But again, part of it's perception. I mean, you know as well as I do that the real estate market, because it lags the overall economy, tends to overcorrect whether it's going up or whether it's going down. And I think what we've seen is that we're seeing resurging prices captured in the 1, 3, and 5 year growth rates because the economy, because real estate prices overcorrected to the downside. And now that we have more availability of capital, fundamentals are beginning to improve, and rents are beginning to grow. You're seeing those significant rates compared to long-term historical averages.
Yeah, and that's a good point that you made about looking at the trough. So you were mentioning that over the last 10 years, if you looked at kind of the overall increase in commercial real estate, what did you say that the range has been there, and that's really not that out of?
Yeah, I mean, when you look at historical, you would think that prices for New York and Boston and Chicago, LA, and San Francisco, they probably could grow easily at 7% a year because of the constraints in those markets, because of the overabundance of population and businesses. And you would think that, realistically, in the non-major markets, for prices to grow at a rate of around 4% probably isn't, unreasonable. Right. But we're spending a lot of time monitoring and watching these conditions, and so far, I've seen disciplined, bank lending, which certainly is a good thing.
I mean, that's a good point. I don't see stupid money right now. I mean, I have seen in past career times, I've seen some stupid money coming in into the market. Right. And if somebody has stupid money to overpay for stuff, you can call my clients that have stuff for sale. We will help you out there, but I've not really seen it, right? So like you said, there's some smart people, the investors, their consultants, the lenders. There's some people that are underwriting this that are looking at it and going, all right, well, like I had Walter Page on the show last week from CoStar, and he mentioned, yeah, Michael, but if you look at, say, a San Francisco building where maybe they're paying a 3 cap, but the rents are so far into market as those rents roll, they're seeing huge upside there. So there's really smart money making these decisions, isn't there?
Absolutely. It's very sophisticated. And one of the things in regards to 3 caps is look back to the question, back to the notion of perception. Some of that money is coming in from offshore, and you look at cap rates in Beijing, Shanghai, Hong Kong, and those cap rates are sub 2.5. So certainly a 3 probably looks somewhat attractive, even though domestically we rarely have seen 3 cap deals for longer than 4 years or so.
Right, especially if they're looking at the safety, right, of the U.S. market.
Absolutely.
And they're maybe not looking for as much a return as to preservation of capital, right? And the U.S. is good, like you said, the economy is improving, and all the analysts that I talk to suggest that should continue, right, because of the lack of new construction. They're suggesting we're going to have rates continually increase, occupancy increase, so banks, do all the loans you want, right?
Well, I don't. Carefully. That's the thing. Discipline is good. Careful and disciplined was good.
I get it. That makes sense. All right, well, stay with us. We're going to have more on the Fed's view on real estate. Stay with us. I'm Michael Bull, and this is the Commercial Real Estate Show.
Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the Fed's view on commercial real estate. We have Brian Bailey here with us from the Fed, and we're talking about real estate and commercial real estate. And so, Brian, where do you think we are in the cycle? I guess everybody realizes that commercial real estate, the economy, and real estate residential cycles. Let's talk about commercial real estate. Where do you think we are in the cycle?
I mean, I think it's it's a good time when you look at it because except for apartments, we have seen very little new construction outside of a few markets. And so for office, for industrial, which we're just beginning to see a little bit of an enhanced rate of construction, retail, it's been very lackluster. You're kind of almost entering a little bit of a sweet spot as we've put more people back to work, more businesses have gone back to work, so there's been a need for more space. So you've taken some of the slack out of the underutilized real estate. You've seen vacancy rates come down. And now I think we've reached a point now where we're kind of nationally, we're seeing some upward pressure on rents. And so with with a minimal amount of new supply in the pipeline, and certainly depending on the size of the project and where it's built and all that good stuff, it could take 18 months or even a little bit longer to see a significant amount of new construction. And so it may give landlords a real opportunity to kind of put some upward pressure on rents. And certainly I think that's good news because we've talked about values and certainly how fast they've gone. A lot of it's been driven by the amount and availability of capital, and now you're really seeing the other component of value, i.e. rents, fundamentals, declining vacancy, beginning to kind of reassert itself and put some upward pressure there on value. So certainly I think it's some good news, and that's probably why you continue to see significant amount of transactions going on. Just saw the recent numbers, and according to our friends at Real Capital Analytics, it's over $500 billion done in 2015 in commercial real estate transactions, which is huge. I mean, it's a very, very strong, significant number. 26% of it's office, 27% of it's apartments. So, the sectors we talked about that were doing very robustly, but you also see, 16% of it in retail, 14% of it industrial, a significant component in hotels. So, I mean, it's really has a wide breadth to it. And I think that people are seeing that fundamentals are improving, and they're making the commitment to make investments in commercial real estate. So I think it's a good time. Certainly, I'd say that it's dependent upon the continued improvement in the economy, and certainly there's an international component to that as well, which we've seen some volatility. We've seen a little bit of caution surface around some of the new regulations that are coming online in 2016. But I think that adaptability is key, and I think they're very smart people in the commercial real estate sector, in the commercial real estate finance arena, and I think that they will be able to adapt to some of this new regulation. Some of it may be a little onerous. I understand it. It may not be perfect, but I think that there's the key is the potential to adapt to it.
Yeah. Well, you mentioned 18 months looks good, and I agree with you. And all the fundamentals look, the employment, the retail spending. You look at the lack of new construction. It does look like continued good times ahead. But what about the folks who say, well, wait a minute, this cycle's a little long in the tooth? is it some of it the slow growth in this recovery? I mean, it seems like it's been a really slow recovery, and why the Fed has had such low rates, right? It's a slow recovery. Does that mean that we could have the good times could last a lot longer this time around?
Can I have another question? Could you give me an easy one, please? And I left my crystal ball at home, but I think really from a supply and demand perspective, with minimal amount of new supply coming online in say the office space, certainly gives perspective for rents to increase, and so I think that some of the conditions are ripe, for in the short term for some movement in rents in industrial and in retail a little bit, but also you've got the trade-off. I mean, we just saw a number of store closings. Whether it was Kmart and Sears, whether it was Macy's, and we've still got a number of firms that are tabulating their profits for Christmas, and so I think that we continue to see the implications for e-commerce and the change it's having on industrial and retail. So certainly it's, again, back to it, performance is kind of sector specific.
Okay, well great. Well, we're going to take a short break. We'll be right back with the Fed's view on commercial real estate, and this is the Commercial Real Estate Show. We'll be right back.
The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're covering the Fed's view on commercial real estate. We have Brian Bailey from the Fed with us here in Studio One, and we talked about the good times are here. Hopefully they'll last a while, and no one really knows, right? So what are some of the potential pitfalls for commercial real estate and banking?
I hope the good times last forever.
Yeah.
I hope. Some of the pitfalls. I mean, there are a number of pitfalls that are potentially out there. I think you have to start internationally and look at some of the volatility that we've seen, whether it's in Europe, the Middle East, or Asia, and certainly it has implications for our overall economy as well as our financial markets. So I mean, that's a potential pitfall. I think here at home, we've talked about the economy doing well, and it seems all indications are that we expect continued growth. But obviously our crystal ball is only as good as everybody else's, and so certainly there are potential things that could derail that. Coming a little bit closer to the financial sector, we've been fortunate, in that the banking environment, responded to coming out of the crisis by, beginning to originate more loans, but they've also been disciplined in doing that. And certainly a potential is that, we don't find the happy medium between, the discipline lending or underwriting that's currently going on, and something where flashing back to 2000, where we saw very enhanced levels of competition. And so I think there's always kind of these factors kind of going back and forth there. I think if you look at we talked about valuations certainly are going up, and that's a potential, because some things that go up do potentially come back down. I think the good news is that my view, the underlying fundamentals seem to indicate that there should only be support for those valuations moving forward. But as you and I know, the capital piece, and we've seen a lot of foreign capital come in, and certainly potential pitfall is foreign capital can be fickle. We saw it in the late 80s, early 90s, and foreign capital came in pretty significantly, and it left fairly quickly. And so I think it's something that we have to continue to monitor. Back to bank lending, I'm aware that we are seeing some appraisers beginning to stretch a little bit. and on some of the assumptions that we see. And certainly I think it's at the point where we have to continue to monitor it. We are monitoring it, but done in conjunction with disciplined bank lending. For instance, banks that are lending or originating at 50 or 55% of value, certainly is a cautious approach. And so certainly it gives them some leeway in case some of those assumptions don't materialize, but certainly a potential pitfall. And then certainly I think you have to look at the regulatory environment. We've seen a lot of regulation that's been placed on the market. It continues to come into effect in the market. There's more regulation coming this year. I believe risk retention is one of the big ones that's coming that has implications for the CMBS originators, which could cause some potential disruption if they're unable to figure out as far as from that capital source. I think the good news is there's still a ton of available capital from a number of sources, but I think that that industry has proven adaptable over the last few years. They've seen a lot of regulation, and so my expectation is that they will adapt to the new regulation. But I think that there are a number of potential pitfalls out there, and I think that's one of the reasons we're asking the question, how could this potentially end badly, and kind of hypothetically trying to look at a number of situations to make sure that we are prepared and we are monitoring the correct fundamentals and dynamics in the marketplace. So that we have a good grasp of what's going on.
Yeah, and you talked about regulations. Talk to us about the changes in FIRPTA and how that might impact
FIRPTA,
commercial real estate.
There's a mouthful, and really a name that we haven't heard since I think 1980 or 1981. But FIRPTA stands for the Foreign Investment in Real Property Tax Act, and certainly there were some changes made to that at the end of last year by the president, and certainly I think that what those changes mean is it liberalized and allowed foreign investors to own a bigger percentage of REITs. For instance, under the 1980s Act, they were limited at 5%, owning 5% share of REITs, and now that's been increased to 10%. The other big piece, I think, is that foreign pension funds receive the same treatment as U.S. funds, and so it eliminated the tax. It allows them to, certainly, own property here in the U.S., and so certainly I think that you'll see more foreign investment as we've made the environment, more conducive, to the foreign investor. And so certainly I think it's a good thing. I've seen some analysts forecast that they think it could mean another 20 to 30 billion annually. I'm not sure I think it will be that much, but certainly when you looked at a $90 billion amount of foreign capital coming in, 20 or 30 billion dollars more certainly is nothing to sneeze at.
Yeah, I mean, a billion here, a billion there. Pretty soon you're talking about real money, right?
Absolutely.
All right, well, stay tuned. We'll have more on the Fed's view on commercial real estate. I'm Michael Bull, and this is the Commercial Real Estate Show. Stay with us.
Xceligent, the resource professionals like CCIMs, CBRE, JLL, Colliers, and Bull Realty use for market intelligence. Commercial Search is the site to market and find available properties to buy, sell, or lease all over the country. Visit commercialsearch.com.
Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're covering the Fed's view of commercial real estate. We have Brian Bailey here who watches real estate for the Fed. And Brian, one of the things I think is on the mind of my viewers and listeners today is what could be the impact of rising interest rates? I think we're all kind of hoping interest rates continue to climb slowly, so it means the economy is good, right? Mm-hmm. Well, what could the impact be on commercial real estate?
Well, hypothetically, and we'll talk. Let's just have a kind of hypothetical discussion around it. I think the first point is you're absolutely right. I mean, the hope is that if we have to move interest rates, it's because the economy is doing well enough that it's signaling that that it's gone very good ground to do that. As far as the implications, certainly it has implications as far as rising debt service. And I think the banks, the financial environment arena is certainly aware that potentially could happen. I think that there are a couple of other things. Certainly it has implications for value, depending on how fast rents are growing. Pardon me. But again, if the economy is doing well, the hope is that rents are growing. I think the other consequence is, right now we're looking global, and you see a number of economies that are not in as good a shape as ours is, and their central bank is in an accommodative standing, whereas if we're beginning to raise rates, if we're tightening, certainly that means that the rates of investment could potentially be better here in the U.S. than in a number of countries overseas, because their economies are not doing well. And I think we are seeing that impact right now through this wave of foreign capital continuing to flow in. So if hypothetically we raise rates at some point in the future, and these countries remain in an accommodative stance, I think that only puts more pressure on foreign investors to potentially look at the United States as a safe haven for an investment. And so I think that then we kind of go back around with another iteration of, more capital, greater abundance of capital availability means that prices could potentially go up a little bit. It could also put a damper on raising rates as far as borrowers are concerned, if there's greater availability of capital and greater need to deploy it. So I mean, it's a balancing act. And there are a lot of circumstances that we continue to watch.
Right. And I know this is your personal opinion and not the Fed's, but let's look at this. Let's say that I'm buying a property today, and I'm thinking that hypothetically in 2 years I'm going to have a 200 basis points increase in interest rates for the cost of my buyer, or 2 percentage points on an interest rate. Should I be concerned about that, or is there enough drive from foreign investment and from improved NOI growth that I'm going to be okay?
So now you're making me get my crystal ball out again, which I was like, I'm leaving it home. But I think so talking, there is a dynamic between rising Treasury rates and cap rates. Cap rates have widened out. The spread between Treasuries and cap rates has widened out significantly. And so I think that really if interest rates begin to move up, which pushes Treasury rates up a little bit, really it will have, and again, depends on how far, how fast, but I think that it has a negligible impact on where cap rates go. I think bigger issue is the supply of money, the supply of capital right now.
Yeah, well, I think those are good points, and I think they're right. There's going to be so much more, hopefully improved in NOI growth, that they're all going to be fine. Well, Brian, thanks for joining us here in Studio One today. We sure appreciate you coming in.
It's great to be here, Michael. Thank you.
And thanks for joining us on one of the 47 stations, iTunes, YouTube, or the show website. Be sure and join us next week. We're going to talk about retail and retail real estate. If you enjoy this show, let us know on Facebook, Twitter, and LinkedIn. Until next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by Bull Realty, a great place to do business. Xceligent, information for the professionals. And Commercial Search, properties for sale and lease. To access these companies or for additional videos, podcasts, and articles, visit CREshow.com.